Hello, hello. Hmm. What's going on, Ryan? Jake, how's it going? Just waiting for people to come in here. We'll see how many people we can get. Going well. Glad to hear it. Hoping to catch some options wisdom between meetings. I think you're in the right place, Ryan. I got a short presentation that I'm going to give that should be helpful. But then we're going to do just more of an open-ended Q&A and see how it goes. See what kind of questions we can answer. But I do have a presentation planned. I just want to allow more people to file in here. Very well. Justify, how's it going? There's your shout out. How many we got? Need to get some more people in here. Anybody have any questions right now? What's up, the only Alan? Kevin, welcome. I'm jealous that you're in Florida. I'm in Denver right now. We just got a bunch of snow and it's kind of cold, but I've had a good winter, but I'm ready for some ocean activities, that's for sure. LT says love your videos. Just want to say thank you for answering one of my questions during one of your Q&As. No problem. If you have a good question, I'll try to give you a good answer. Jake asked, do you still work with Tom and the Tasty folks, or just by coincidence do you use the platform? So I don't work with them directly, but I am an affiliate marketing partner for Tastyworks, as you may have seen in some of my other videos. Um, but I wouldn't do that if I didn't believe that Tastyworks was a great trading platform for options traders, and I firmly believe that options traders, especially people that trade with a lot of size and are very active, I think Tastyworks is a great place to be, especially if you trade more than 10 contracts, because they have the commission cap. So if you trade 100 contracts, for example, you will pay a maximum of $10 per option leg. So if you buy 100 call options, normally if you were paying $1 per contract, you would pay $100 in commissions to buy 100 contracts of an option. But with Tastyworks, they have a $10 commission cap, $10 per leg. So basically, if you buy 100 call options, you're going to pay $10 in option contract fees, and that'll be the maximum per contract fee, but you will still pay the regulatory and exchange fees per option contract, but that will be very, very cheap. It's just a few pennies here and there. So if you're trading with large size, meaning that you frequently trade more than 10 contracts, then tastyworks is a no-brainer options trading platform to be with, in my opinion. And there is a link in the description if you don't have a tastyworks account and you're interested in opening one. There is a link in the description below where you can learn more about tastyworks, and if you sign up and use the project option code, that supports the channel here. So if you enjoy what I do here, which is mostly free content for you guys, pretty much free content at this point, and you want to support my work, then opening an account with tastyworks and using the project option code is a phenomenal way to support me and say thank you. Let's see what we got here. We got some more people coming in, so I'm going to start this presentation in just a little bit. We're talking about my favorite options trading strategy in recent history, at least, and then I'm going to break down for all of you kind of the numbers, and we're going to go through a real example that I did in Tesla, and I'm going to try to explain to you why I love this strategy so much. Ricky asks, when's Tasty coming to Canada? It's a good question. I don't know, but I think they're coming to Canada soon. I don't work at tastyworks, so I don't have any inside information, but they will be in Canada soon. Hopefully this year, but I don't know. There's a lot of regulatory things that they have to go through. The Only Alan asks, are you bullish or bearish in this market? I'm bullish because of the monetary policy that we're seeing. Since the government has been going through lots of stimulus programs and they've been creating a lot of money out of thin air, essentially, interest rates are super low because money is abundant. And so the cost of borrowing money is very low. And on the other hand, or in the same way, if you have your money in a savings account, you aren't going to get paid much for having your money in that savings account because the supply of money is so high, and therefore it's not very scarce. So you don't get paid much for putting your money in a savings account or a conservative investment product such as a government bond. And for that reason, people are incentivized to go to higher risk assets such as stocks or something like Bitcoin because since you can't earn any money with a savings account or a low risk conservative product like a government bond, you actually have a negative return in those products, because if inflation is 2% and you're earning 50 basis points or 0.5% in a savings account, your real return is actually negative 1.5%, which means that your purchasing power is losing 1.5% per year. If inflation is 2% and your savings account earns 0.5%. And for that reason, if you put your money into a savings account or a low risk investment vehicle, you have a negative real return. And so if you want to have a positive real return, you have to go to riskier assets such as the stock market. And for that reason, I think the stock market is going to continue to increase. And that's why I'm bullish on the stock market. So it's kind of a macroeconomic theory behind my bullishness on the stock market. Again, that's doesn't mean it's going to be true. We could obviously see a bearish market, but that is my thesis for now. Evan Fisher, how's it going, man? Currently out doing Uber Eats. Get that money. Keep up the grind. Happy St. Paddy's Day. Thank you. You as well. The Jake says, my favorite strategy is the risk reversal. That's incorrect. We'll get to that in just a minute. DNMC, thank you for the $5 super chat. How do you feel about 30 DTE, 30 Delta covered calls on UPRO? I'll just do this really quickly, and then I'm going to get to the presentation, which is my favorite options trading strategy. 30 DTE, 30 Delta covered call. So a covered call means you already own 100 shares of UPRO, and selling the 30 delta call would be selling this 95 call option here. And let's look at the stock chart. So 95 would be an all-time high. We just recently got to new all-time highs, and 95 is fairly close, I'd say, for 30 days, since we just saw the stock go to from 75 to 90 in just a few trading days. I would say a 95 strike, even though it's 30 delta, that's still pretty close. It all gets back to, do you want to sell the shares? Is this a long-term hold for you? If this is a long-term hold for you and you don't want to get rid of your stock, then I would say a covered call is a bad strategy. Just because you can earn a premium by selling a covered call, it doesn't mean that you should sell a covered call. Like, for example, I own shares of Tesla, and I want to hold that position long term, and for that reason, I'm not going to sell a call on Tesla, even though I could earn a few $1,000s in premium if that call option were to expire worthless. So I would say if you're comfortable selling at 95, then go ahead and sell that 95 call. Just know you're not going to get much premium for it. You're only going to get $190 for giving up your upside in the stock. And if you think that's worth it, then go for it. All right. No, Brian, you're not too late. You're right on time. So I'm going to start the presentation now, and I'm going to talk about my favorite options trading strategy in recent history. So today we will investigate my favorite options trading strategy that I've used with great success in recent history. And this strategy consists of first buying a call option in a company or product that I or you believe will increase, and then adjust away all of or more than all of the risk whenever possible. So with this strategy, it is possible to also create a guaranteed profit scenario, which we will see in the upcoming slides. So an example of this strategy is one that I actually used in Tesla. So on September 23rd, 2020, Tesla was trading for around $410 per share. And by the way, these share prices are adjusting for the split. So on September 23rd, 2020, Tesla was trading around $410 per share. Now, with a very bullish outlook on the stock, I purchased the 900 call option in the January 2023 expiration. So this is 2 years out. And as of September, it was more than 2 years away from getting to expiration. So I bought the 900 call January 2023 in Tesla for $101.30. That was the entry price of the option. Now, if you've watched my Options for Beginners video, you know that the price is not actually representative of what I actually paid for that option. So we have to multiply that price by 100, and that gives us a premium of $10,130. So on September 23rd, I paid just over $10,000 for this 900 call option in January 2023. That's the expiration cycle. And so with the share price at $410, since I purchased a way out of the money call option with over 2 years to go, this is a hyper bullish strategy. Now at the time, I wasn't necessarily thinking that Tesla was going to shoot up to $900 per share. Basically, I was just putting money into a highly leveraged position, which is a long-term out-of-the-money call option. And so even if Tesla goes from $400 to $600 in a few months or a year, this 900 call option will appreciate. And that's exactly what happened. So it happened very quickly. I actually have to change this. January 8th, 2021. Sorry about that. So on January 8th, 2021, Tesla had increased to around $860 per share. When that happened, I was looking at options in Tesla. I already owned the 900 call. And now, since the stock price went from $410 to $860 in just a few months, the 900 call that I owned was a highly profitable position. And that's the only position that I had of these two options. But on January 8th, with Tesla around $860 per share, I shorted the 1500 call in the exact same expiration cycle as my original long call position. So I bought the call here at the 900 strike. Tesla went way up, and then I shorted the 1500 call option, same expiration, and I received $23,300 for shorting that option. And so the resulting position of these two separate transactions is that I own the 900 1500 bull call spread for a credit of $13,170. Now, typically if you were to buy this call spread, which we'll look at in just a minute, if you were to buy the 900 call and short the 1500 call, and you did that right now at the same time, you would pay a very significant amount of money to enter that call spread. So when you buy a call and then you short a higher strike call at the same time, you pay money to enter that trade. That's called a call debit spread or a bull call spread. And it's called a call debit spread because you pay to enter that position. But in this case, since I did it in two separate transactions, I actually got this call spread for a huge credit. And that's because, again, I bought the 900 call and I paid just over $10,000 for it. But then the stock price went way up, and then I shorted the 1500 call for $23,300, resulting in a bull call spread for a $13,000 credit. So the resulting position is that I, again, paid $10,000 for the 900 call, received over $23,000 for shorting the 1500 call, and I got into this bull call spread for a credit of just over $13,000. Now, the reason this trade was able to be constructed for a credit is because I entered both options at different points in time. Now, this is something that has confused people in the past, where they've said, how did you enter this trade for a credit? Because, as I've mentioned, typically you pay to enter this trade. And the reason is that I first bought the 900 call, and then the stock price went way up, which means the 900 call was now more valuable. And at the time, the 1500 call was actually more valuable than what I paid initially for the 900 call. And so I have a screenshot here. If I were to buy the 900 1500 call spread in the January 2023 expiration cycle, and I did that right now, and I bought both of those options or transacted both of those options right now at the same time, then I would have to pay over $8,000 for this trade. So if we can see that I buy the 900 call and I short the 1500 call simultaneously, we can see that this trade has a cost of $8,660. And we can see that, as I've underlined, it says the maximum loss is $8,660, and that is also my buying power effect. So the last slide I'm going to share here before we actually go and analyze this position is that with using this strategy, you can significantly reduce the risk of your profitable position or turn it into a position with guaranteed profit potential. You can also reduce your bullish exposure, as shorting a call option is a negative delta position, meaning that when you short a call option, you lose money on that position as the stock price increases, but you make money on it as the stock price falls. And that subtracts from your positive delta position, which is the original long call position. So when you have a call option that you own, that is a positive delta position, meaning that you make money if the stock price goes up and you lose money as the stock price goes down. So by shorting that additional call option, I actually reduce the sensitivity of the overall position relative to changes in the stock price. And then additionally, you can trade in and out of the short call position and potentially increase your profitability, which we will take a look at right now. So one thing I want to actually clarify is the reason that this is a guaranteed profit position is because since I paid $10,000 for the 900 call and I received over $23,000 for shorting the 1500 call, at expiration, if Tesla is below $900, then both of these options will expire worthless. And that means I will lose $10,130 on that 900 call that I purchased. But since I shorted the 1500 call for over $23,000, if this option goes out worthless, then I will effectively make $23,300 on that position. And my overall profit would be $13,170. So by doing this maneuver, which was buying a call option, the stock price goes way up, and then shorting another higher strike call option to create a call spread for a credit. If both of these options go out worthless, since I collected a credit for it, I will actually still make money. Versus this spread, which is if I were to buy this spread right now and I paid $8,660 for it, if both of these options go out worthless, then I will lose $8,660. So by actually legging into this call spread, that means that you enter both trades at separate points in time. Since I was able to do this for a big credit, it actually gives me a guaranteed profit scenario. So if we go to tastyworks and we look at my position, we can see that, well, first of all, if I just look at this spread that I have queued up, which is buying the 900 call and shorting the 1500 call, we can see that the price of this position is $8,575. So Peter asked, what do you call this type of spread? This is a long call spread, or a call debit spread, or a bull call spread. Those are the three names for this spread. So it doesn't change the name of it. It doesn't change the name of the position, but since I did these transactions at separate points in time, I was able to get a more favorable entry price for the overall position. But it can also work against you, because if you buy a call option and the stock price falls, and then I were to short that 1500 call, I would actually collect a lot less for the 1500 call than I would be able to right now with the stock price where it is. So it can work against you as well. But the reason that I love this strategy is because I was able to create a risk-free position. Now you'll notice when we look at the spread right now, it says that my entry price for the 1500 call is $117. And that's because I actually bought back the short call when Tesla fell, and then I re-entered the 1500 call. So if we go to my activity, we can see that on January 8th, I shorted the 1500 call for $233. And then on February 23rd, I bought it back for $118, let's call it. And so on that transaction, I basically took $10,000 in profit from that position. Actually, yeah, it's a little over $10,000 in profit, since I shorted the call for $23,000, and then I later bought it back for just under $12,000. I realized a profit on that short call position of just over $10,000. But then I actually went out and re-shorted it, and I ended up getting in at the same exact price. And so the most recent price that I entered that 1500 call is $117.70. Now, getting back to what I said before, which was that it reduces your bullish exposure. If we look at the 900 call position by itself, we can see that the delta is a positive 59. And that means if Tesla goes up $1, this 900 call is expected to make $59 for me. And if Tesla goes down $1, then this call is expected to lose $59 for me. But if we look at the 1500 call by itself, we can see that the delta is negative 40. This means that if the stock price goes up $1, I'm expected to lose $40 on this call. But if it goes down $1, I'm expected to make $40 on this position. And so when we add those deltas up, we get positive 59 and we subtract 40 from it. That means that this call spread has a positive delta of around 19. And so after I shorted the 1500 call, now this call spread has a delta of positive 19, which means that if the stock price goes up $1, I'm expected to make $19. And if the stock price goes down $1, I'm expected to lose $19. If we compare that to the original call position of the 900 call, a delta of 19 is much less sensitive than a delta of positive 59. So it reduces my risk by turning this position into a spread. All right, now I'm going to go through some questions because I know that was a lot. Let's see here. Only Alan asks, how would you exit this kind of position early? Well, I could, if I were to get out of it right now, if I highlight both of these options and I right click and hit close position, then I could sell this call spread right now for its current price of $85.45. And that means I would be selling it for a total premium of $8,545. And so that's how I could exit it right now, and I could take that profit. Right now it's telling me my profit is $10,000. So it says if I close this call spread right now, it says that my profit will be just over $10,000. That is based on the recent entry price of this short call of $117. So it's basically saying I originally bought the 900 call for $10,130, and then I shorted the 1500 call for $11,770. And so it's basically taking that credit between those two prices and it's adding it to the sale price here, which means that it's coming out to a credit of just over $1,400. But it's actually, if I were to close this right now, the overall profit would be a lot higher than that, because originally I shorted the 1500 call for $23,300, and then I bought it back for $117. So I took a big profit out of that. And so the overall profit, if I were to close this right now, would be closer to, let's just call it $20,000, just to make it a little more simple. But that's how I would close this position early, is I could close it right now. Even with Tesla at 670, I could sell the 900 1500 call spread for 8,600, and I would essentially close out the position and I would keep all this money. So remember, I entered this call spread for a big credit, and if I sell this call spread here, I will get another credit essentially, because selling a call spread means that you will collect money into your account because you're converting the options into cash. And so if I were to sell this call spread for $8,500 or $8,600, I would collect $8,600 into my account, but I entered this spread overall for a $13,000 credit. So if we add those two things up, then that would make my profit somewhere around $22,000. Nicolo asks, I'm new, where can I get to his screen? A specific brokerage or app? Nicolo, this is the tastyworks brokerage platform. As mentioned earlier, there is a link in the description below where you can learn about tastyworks. And if you so choose to open an account with tastyworks and you use the project option referral code, that will help me out and support the channel. Doesn't cost you anything to do that. It just basically is telling tastyworks that you are coming to them through me, and that helps support the channel. And again, it doesn't cost you anything. Just do your research, figure out if tastyworks is somewhere that you'd want to trade with. I personally love the platform because I think they have a lot of cool features, and it's not too complex, because some trading platforms have a lot more advanced functionality, and when you have all that on your screen, it can get even more overwhelming. Admittedly, it's going to take some time to learn whatever brokerage platform you trade with, but I think tastyworks is very straightforward. On the left-hand side, I have my watch list, which is basically stocks and products that I'm watching. And then I have my positions tab, which is all the stuff that I have on. I can go to the trade tab and look at the different options. And if I go to a different stock, so if I click on Facebook, for example, then everything here automatically changes to Facebook data. So I really like trading with tastyworks because it's a very connected platform, as I just showed you. So like if I'm looking at the chart and I change it to IWM, then this changes the chart to IWM, and it's just very simple for me to use. Nigam asks, why don't you book the profit when you shorted the position? So that's another really good question. They are asking, when I shorted the 1500 call option, why didn't I just sell the 900 call? And the reason is I didn't want to completely exit the position, because if I bought the 900 call and then instead of shorting the 1500 call to turn it into a risk-free call spread, by avoiding selling the 900 call, I can actually stay in the position. So if we look at the width of these strikes, I own the 900 call and I shorted the 1500 call. And therefore the width of these strikes is $600. And that means that the maximum value of this call spread at expiration is $600. And that would require Tesla to be above $1,500 per share. So basically, I took all the risk out of the position, but I can still hold it and make a ton more money. Because if we look at it right now, the call spread is worth $85 or $86. So let's just say the overall value is $8,600. But the call spread could be worth $600 in the future. And if we multiply $600 by 100, we can get the total, the maximum potential overall value of this call spread. And that comes out to $60,000. So since this trade has 675 days left, if Tesla goes up to $1,500 or more by the January 2023 expiration, which is just about 2 years away, then this call spread could go from just over $8,000 in value to a maximum value of $60,000. And that means I have a ton more profit potential on this trade, but my downside is still profit, because remember, I entered this call spread for an overall credit, and therefore, if the options go out worthless and Tesla stays right here over the next 2 years, I will still end with a profit on this position. But if I hold it and Tesla shoots way up over the next 2 years, then I could potentially make another $50,000 on this position. So it's basically, I just have to hold it and wait and see what happens, because if things go very well and Tesla performs well and their stock price increases, then I could make another 5 figures on this trade, but my downside is still guaranteed profit since I did enter it for a big credit. So that's why instead of selling the 900 call, I turned it into a call spread with no loss potential. Samuel asks, are you going to make the slides available on your website? Yes, I can make it into a Dropbox link, and then I can put the presentation slides in the Dropbox link in the description of this live stream once it is uploaded. So after the live stream is over, YouTube will process the live stream and then it will be available for reviewing on the channel. And then in that description, you can go ahead and look at the slides that I've presented here. Does this play involve collateral? That's a good question. So yes, initially when I bought this 900 call option, I paid $10,000 for it, and therefore the collateral was $10,000. When you buy an option, you need to have as much money as that option costs in your account. So if you want to buy an option worth $10,000, then you need $10,000 in your account that is available in cash to allocate to that option. But once I shorted the 1500 call option for a higher credit than I initially paid for the 900 call, it actually removes all of my margin requirement. Because since I paid $10,000 for the 900 call, and then I shorted the 1500 call for more money than I initially paid, it actually relieves all of my margin requirement because I entered the position for an overall credit. And tastyworks, the platform, recognizes that I can't lose any money on that position and that I have essentially a guaranteed profit if I am to hold that position through expiration. But as I mentioned before, I did buy back the short call. So if we look at this, if I go to close the short 1500 call by itself, we can see what happens. So right now the 1500 call is worth $123.85. Let's just make this a round number and go to 124. So if I want to buy back the short call for $124, I have to pay $12,400, and that will actually increase my margin requirement on this position. And we can see that tastyworks recognizes that because it says my buying power effect here is a $12,400 debit. So if I wanted to close out the 1500 short call, I would have to pay to exit that short call position, and my margin requirement would actually increase by whatever I buy back this call option for. So when I did initially short that 1500 call, I actually relieved all of my margin requirement and actually credited my available buying power by $13,000 since I entered this call spread for an overall credit of $13,000. So that's a good question. Someone asked, what part of Denver do you live? I live in the Highlands in Denver. And they said, were you able to clear the snow? Well, the snow is melting. If you don't know, Denver got like 3 to 4 feet of snow last weekend. I was actually in Salt Lake City, and my flight home got canceled, so I didn't get back until yesterday. And there's still a lot of snow on the ground, and it's currently snowing a little bit more. So the snow is getting cleared, but it's still there. Connor asks, has this strategy been profitable in any other trade, or was it kind of luck because Tesla took off fast? That's a good question. And to answer your question, I have used it in MicroStrategy. So here, the same thing happened. Again, it does require the stock price to increase after you buy the initial call. But in MicroStrategy, we can see that I bought the 500 call for $78. So I paid $7,800 for the 500 call in MicroStrategy. And then we can look at the days open for these trades. So it says 98 days ago, I purchased the 500 call. And then 42 days ago, I shorted the 1,000 call, and I collected $21,000 for this short call position. So again, if we look at the credit of this position, again, it's around $13,000 because let's say I paid $8,000 for this. I'm just rounding. I paid $8,000 for this call, and then I shorted a higher strike call in the same expiration for $21,000. And my overall credit for this position is therefore around $13,000. And just like Tesla, that means worst case scenario, I will make $13,000 on this position, but I can still make a lot more if MicroStrategy goes higher than 1,000. Gaurav asks, what do you mean you enter the spread for a credit? Did you sell a call credit spread at different strike prices? No, this is not a credit spread. This is when you buy a call option and then you short another call option at a higher strike price. That is not a call credit spread. That is technically called a call debit spread. And the reason it's called a debit spread is because if you buy those two components at the same exact time, you have to pay for it. So I'll give you an example right here. So if I buy the 750 call and then I short the 900 call, I have to pay just under $4,000 to enter this trade. Gaurav, what you're misinterpreting is that I entered the trades at different points in time. So if we just stay with MicroStrategy, I bought the 500 call 98 days ago. So 98 days ago. And then I shorted the 1,000 call 42 days ago. This means that I was holding the 500 call for 57 days or 56 days before I shorted the higher strike call. So I bought the 500 call, and then 50 plus days later, MicroStrategy was a lot higher, and then I shorted the higher strike call. So I created the call debit spread, but since I collected more on the short option than I paid for the initial 500 call, it is entered for a credit. So to make things really confusing for you, I bought a call spread for a credit, which means I didn't really buy it. I entered the trade and I collected more money than I paid out, and therefore I entered a call debit spread for an overall credit. So I know it's confusing because buying a call spread is called a call debit spread, but in this case, since I did it in two different transactions, and I did it for an overall credit, it's confusing to call it a call debit spread. So let's just call it a bullish call spread, which means it makes money when the stock price goes up. But since I entered the two parts of that trade at separate points in time, and I collected more money than I actually paid out, when we add up those two transactions, I entered the bull call spread for an overall credit, which means it's a risk-free trade. What kind of trade did I do with Visa? Let's see here. Long calls. So I did this 42 days ago. So I bought so this is a good example right here. Let's go see what I could potentially do with this Visa position. So 42 days ago, I purchased 5 of the 250 calls in Visa, and this is in the January 2023 expiration, which means it has 674 days until expiration. So this is a really long-term, long call position. And I entered these calls for $15.25. So I bought 5 of them for just over $1,500 a piece. Now they are trading for $22.50. Okay? And since this is a profitable position, I know that there is another higher strike call option than 250 that is going to be trading for somewhere around $15. Because if the 250 call is trading for $22.50, maybe the 260 call is trading for $18, or maybe the 270 is trading for $15. Let's just go ahead and take a look. So if I open up the Visa trade page, this is giving me all of the expiration cycles that I can trade. This white dot here is indicating to me that I have a position in this expiration cycle. So I'm going to click on this to open it up. And we can see that I bought 5 of the 250 calls. And based on my positions tab, we can see that my entry price was $15.25. So if I go to the 270 call option, we can see that the 270 call option is trading for $16.55. Okay? So if I were to sell 5 of these call options for $16.55, I would create a risk-free call spread in Visa. The problem for me is that it would only be 20 points wide. My goal with this strategy is to get a really wide call spread for a credit. And I don't want a 20-point wide call spread in Visa in a 700-day expiration cycle, because the trade would not be very sensitive at all to changes in Visa. And since the trade is not that profitable yet, I don't want to make this adjustment too early. So in the Tesla example, remember that the Tesla position I entered that at $410 per share when Tesla was at $410 per share. And then I made my adjustment when Tesla was at $860 per share. Now, I'm not saying that I'm not going to adjust this Visa position until Visa goes to $500 per share. I don't think that would happen within this time frame. But what I am saying is I want to wait a little bit longer so that maybe I can get the 300 or the 350 call and sell that for $15. But really quickly, let's go back to this position. Notice how if I were to short this 270 call for $16.55, it's telling me that my buying power effect is a credit of $16.55. Now this means that if I were to short this one call option for $1,655, it would reduce my margin requirement on this overall position by $1,655. And that's because I'm not adding any more risk to this position. In fact, I'm reducing the risk of my Visa position, because shorting a call at a higher strike price than a call that I already own, it does not add any risk, because all of that risk is covered by the calls that I actually own here. And so if I were to actually short 5 of these, I could completely eliminate the risk of this Visa position, because since I can short these 270 calls for a higher price than $15.25, which is what I paid for each of these 250 calls, I would create a risk-free call spread. Does everybody understand that? So I paid $15.25 for the 250 calls. And since I can short the 270 calls for more than $15.25, if I were to do so, then I would create a risk-free call spread position. Does everybody understand that? Because if I buy the 250 call for $15.25, the most I can lose on that is $1,525. Okay? Because if the call option goes out worthless and I paid $1,500 for it, then I lose $1,500. But if I were to short the 270 calls for $16.55, then if the 250 calls are worthless, meaning that if Visa is under 250 at expiration, then the 250 calls will be worthless and the 270 calls will also be worthless, which means I will lose $1,525 on the 250s that I bought. But if I were to short these 270s for $16.55 and they go out worthless, then I will make $1,655 on the short calls. So I will lose $1,500 on the long calls and I will make $1,650 on the short calls, and that means overall I will make $150 per spread, essentially. Young asks, when would be a good time to short the high call strike? That's really subjective. It really depends on what you think is going to happen. If we compare Visa and Tesla, Visa is a much larger, more established company. Visa is not nearly as volatile as Tesla. And so, like I said, I'm not expecting Visa to go from $220 to $400 in a few months. I don't think that's going to happen. And so I'll probably adjust this position sooner than I did in the Tesla position. The Tesla position worked out so nicely because look at how fast Tesla increased. Tesla was at $400 per share, and then in just a couple months, it went up to $800 per share. So the stock price went up 100% in a couple months, and that's why I was able to get such a favorable entry price for the call spread. But that's not going to happen in Visa because, as I said, Visa is a much larger company. It's much more established. It is not a high-risk, high-growth company like Tesla is. And so I'll probably adjust this pretty soon. But I want Visa to go up to a higher price. Honestly, I would like to see Visa go up to, let's just call it like $250. So if Visa gets to the strike price of this call option in the next few months, I'll probably look to adjust this position. Campo says this is exactly a poor man's covered call. Not exactly. A poor man's covered call is a diagonal spread, technically. A poor man's covered call is when you buy a long dated in the money call option and then you short a more near term out of the money call option. So it's not in the same expiration. A poor man's covered call is technically a diagonal spread. What I did here in MicroStrategy and Tesla, and I didn't do it in NVIDIA. I did it in Square, so I did it in Square as well. So I have the 290s that I bought for $29.50, and then just a couple days ago, I shorted the 420s for $28.35. So this is not technically a risk-free call spread, but it's essentially a risk-free trade because since I paid $29.50 for the 290s, and then I shorted two of the 420s for $28.35. The entry prices on these are fairly close, but overall this is still a debit spread. So I bought the 290s for $29.50, and I shorted the 420s for $28.35. So essentially I bought the 290 420 call spreads for a net debit of $1.35. So almost free, but not exactly. Someone asked, will this be added to your videos on the homepage? I definitely want to rewatch this. Yes. So after the live stream is finished, YouTube will take some time to process the live stream. And then once the live stream is processed, it will be uploaded to the channel so that you can rewatch the live stream in its entirety. And also I'll put timestamps in the description so that you can quickly see on the video playhead where different sections of the video are. So you'll be able to skip exactly to specific sections in this video based on what I'm explaining. I am Dillian, sorry. Thank you for the $5 super chat. I bought a put option 65 days out and it's in the money. The stock is going down, but I'm down by $26. Why isn't my profit going up? Can you elaborate on that? Can you tell me what stock it's in, what your strike price is, what you paid for the option? And then I can tell you. So I need the strike price of the option, the stock, and I need how much you paid for that option, and I need to know what expiration it is in. Quang asks, is the stock market always this much sensitive to the bond market? I would say, I don't really know. I'm not an expert between that relationship, but I will say the stock market is reacting negatively to an increase in interest rates because, as I mentioned before, if interest rates stay super low, then there is a higher, we call it a higher risk premium in the stock market. So if the risk-free rate, I'll just make this very simple. If the risk-free rate is 0%, meaning the amount that you can earn on your money risk-free is 0%, that means you can't earn any money for free. You can't put your money into a government bond and make risk-free money. And if the average stock market return is, let's say, 7%, then the equity risk premium, what we would say, is 7%. So the equity risk premium is what's the return that you can expect with stocks versus the return that you could expect in a risk-free investment such as a government bond. And so if the expected return in stocks is 7% and the risk-free rate is 0%, then that means you can make 7% in additional expected returns by putting your money into stocks versus putting your money into bonds. Now let's say the risk-free rate goes up to 4%. So that's a huge jump. So I could put my money into a government bond and earn 4% on my money without taking any real risk because that government bond is backed by the US government and they have a really good credit rating, and that means that there's a very, very low chance that you won't get your money back. So let's say the risk-free rate goes up to 4% and the expected return in stocks is still 7%. Now we would say that the equity risk premium is only 3% because if I put my money into stocks, which are very risky, I can earn 7%, or my expected return is 7%, but I can also put my money into a risk-free investment such as a government bond, and I can earn 4% on that investment, and therefore there's only a 3% advantage to putting my money into stocks. And so where I'm going with this is the higher the risk-free rate gets, there's a lower advantage of putting your money into something risky like stocks. And therefore more people will choose the risk-free investment over stocks. And if more people are choosing the risk-free investment over stocks, then that means there's less money flowing into stocks, and that means there's less demand for stocks, and that means that the stock market will not perform as well compared to a scenario where there is a higher equity risk premium, meaning that the difference between what you can earn in stocks versus what you can earn in a risk-free investment, such as a US government bond, the higher that relationship is, the more attractive the stock market becomes. So the reason that the stock market doesn't like an increase in rates is because the more money that you can make without really taking any risk then that becomes more attractive relative to putting your money into something that's risky like the stock market. So that's why the stock market reacts inversely to interest rates, generally speaking. Satoshi Nakamoto, what's good? Satoshi Nakamoto, Bitcoin is my opinion. I buy the dip. I love that. I'm a big Bitcoin believer. Hey, really quickly, I want everybody to participate in this. Just put yes or no. Do you own Bitcoin? Put yes or no. Everyone participate. I want to see. Do you own Bitcoin? Answer yes or no in the chat, please. Okay, it's looking pretty even. Pretty even split. Keep answering. Do you guys own Bitcoin? Answer yes or no. Bitcoin fund. Okay, so you have some GBTC. JBATL says, I don't trust Bitcoin. All right. Now, I want to know, are you interested in me doing Bitcoin content? Yes or no? Doge to the moon? Perfect. Well, I will be doing Bitcoin related content very soon. So stay tuned for that. I'm going to do some evergreen type videos where I will explain generally how Bitcoin works and why people are responding favorably to it, why people are responding negatively to it. Levi says, stick with stocks, please. Sorry. I will be doing crypto related content with a focus on Bitcoin. It's not going to be a ton of videos. The focus of this channel is still going to be, I'm still going to be doing lots of options trading content, but here and there I will sprinkle in some other stuff. And the reason I'm going to do that is because I want to share with you all things that I believe in and things that I have had I've had a good time learning about and things that I'm investing in. I basically want to share with you everything that's a part of my philosophy because I said it before, if you're watching this channel, then you probably are interested in making money. And if I want to make a video that I think will help you make money, then I'm going to do that. Please don't title your video Bitcoin to 100K. But that's where it's going. No, I'm just kidding. Don't take anything I say as investment advice, please. Does Bitcoin have options? There are options in Bitcoin. To be honest with you, I don't know how to access those. You can't access them on tastyworks. You have to open an account with a different platform that offers Bitcoin options. Can we short Bitcoin? Yes, you could short a Bitcoin future, but I would not recommend that. I don't generally, not just Bitcoin, I don't really believe in shorting most things. I think people get into a lot of trouble shorting things or betting against things, and we saw exactly what happened to GameStop. Speaking of GameStop, where is it? $219. JBATL says Bitcoin is not backed by anything, pure speculation. How about GME? GME is pure speculation. All right, we need some more questions here. Oh, sorry, I got to get back to I am Dillian. He says the stock is SVRA. So let's go see what's going on with this trader's position. He says, or they are saying that they bought a put option and they are not making money even though the stock price is falling. May 21, and they bought the 250. So the reason you're having trouble making money is because this put option only has 2 days left until it expires, and therefore it is decaying rapidly. So if you look at the price you paid for this put option, you paid $1.20, which means if the strike is 2.5 and you bought the option for $1.20, your break even on this trade is $2.50, which is the strike price, minus what you paid for it, which is $1.20. And that gives us a break-even price of $1.30. So for you to make money on this position at expiration, this stock needs to be below $1.30. Because at $1.30, the 2.5 put will have $1.20 of intrinsic value, which does not decay. And that's because you paid $1.20 for it. That's what you need the intrinsic value to be at expiration to not lose any money. And since expiration is 2 days away, this option is about to go out worthless. Not worthless, I'm sorry. The stock price is at $2.15, and so it has 35 cents of intrinsic value, and you need it to have $1.20 of intrinsic value. So the reason that you didn't make money on this trade is because your break even was $1.30, which is right here, and the stock price did not fall fast enough based on how much time is remaining until the option expires. So basically, if SVRA is not below $1.30 in 2 days when it expires, then you're going to make money. GME is literally worth $6. You're right. And I will go on the record and say I was wrong about GME. When GME was at, I did a live stream and GME was at $43 or whatever it was. And somebody said that they asked me if they should put their life savings in GME and YOLO some long options. And I said GME was dead. And I said GME would not get above $100. And now it's at $220. So this stock is pure speculation. No part of this movement in the stock price is attached to fundamentals. Because the stock price was $10 and then it went to $500, $400 in a couple days, which is just a massive short squeeze. And then it got back down to $40, which is closer to reality, and now it's back at $220. But the fundamentals of GME's business have not changed that much in this time period. So this is just I call it a gambling vehicle, meaning if you're trading GME, you're basically just trading it for the volatility and not anything else. And that's fine, but just see it for what it is. Jake says it's not about, he says SVRA was not a theta decay thing, it was a volatility crush. Well, you're right. It could have been both, but I don't have the volatility numbers. All I know is that they paid $1.20 for this 250 option, 250 call option, and the stock price did not fall fast enough. So that's a combination of, it could be a big decrease in volatility, and given how rapidly it increased and came back down, I will say you're right. It's probably also a implied volatility crush, meaning that the extrinsic value of the options is decreasing because the expected volatility of the stock is decreasing as well. But their biggest problem, I'm not sure if it's a man or woman, but the biggest problem is that they only have 2 days left until this option expires. And with the stock at 215, they need the stock price to go down a lot more, because with 2 days left, there's not much extrinsic value in the option. See, if I pull up EXT, the 250 put has 3 cents of extrinsic. March, May, geez, sorry. I'm sorry, everybody. May, not March. Same thing. All right, if you bought it for $1.20, it has 53 cents of extrinsic. I'm sorry. Same thing. You need the stock price to continue falling. So yes, based on the fact that it has 65 days to go, I don't know when you bought this option, but depending on how long ago you bought this option, then it's probably related to an implied volatility decrease. They are right. The people are right. If you bought this a couple days ago and you're down money right here, then it's probably because of an implied volatility decrease. So on a stock like this, if you see a massive increase, then the implied volatility, which is the extrinsic value in the options, that will explode, because if the stock price all of a sudden becomes a lot more volatile, then traders will jump in and start buying up the options like crazy, whether they think it's going to continue to go up or if it's going to go down. And that increase in demand for the options will lead to more expensive options extrinsically. And then if the hype kind of dies, as it did here, and the stock price goes back down, then implied volatility will likely contract, as my smart viewers are saying, and therefore that's probably why you lost money. So yes, the comment section is smarter than I am today, and you're probably losing money because implied volatility is decreasing. See, you guys are very smart, smarter than me. If we look at these two things, there's only one different letter. It's MAR versus MAY. That's why I made the mistake. I'm getting a couple questions about Alex. Thank you for the $2 super chat. I appreciate it. Alex asks, I bought a TDOC April 2021. Well, Alex, I need your strike price. If you ask a question about a specific position, I need all the details. I need the expiration, the strike price, your entry price, and then we can go from there. I'm assuming you're talking about the 200 call. So you bought the 200 call in April, which has 30 days to expiration, and you bought it for $12.55, $2.05. You bought the 200, I'm guessing, yeah. And so if the stock price is down after you bought it, now you need the stock price to go up over, since you bought it for $12.55, which means your break-even price is right around this line, and you have 30 days for the stock price to get to your break-even. But basically, you need the stock price to go up pretty quickly to get your money back, since you bought it for $12.55 and now it's at $8.30. So you're down about $400, and you need the stock price to go up to get that money back, because if the stock price goes up, then this call option will increase in value. But since you only have 30 days, you need that movement to happen pretty quickly. I'm not sure what's going to happen with TDOC. What I do know is that you don't have much time. So you need this trade to turn around very quickly. Otherwise, you're going to lose money very quickly, because this option is 100% extrinsic value. If we look at this EXT column right here, this is extrinsic value. And since the option price is 825, the EXT is 825, this option is pure time value, which means in 30 days, if the stock price is at where it's at right now, then you're going to lose another $830. So you need the stock price to go up quickly. Otherwise, you're going to get vaporized, so to speak. Chris, are you planning to do the live stream regularly? Yes. Yes, I'm going to be more regular with the schedule. The winters are really, really hectic for me because my family does 2 ski vacations in the winter, and that takes up 2 weeks. And then we have the holiday season before the turn of the new year. And then my friends go on ski trips, so I join them on those. And for the past few months, I feel like I haven't really been home consistently, and it's hard for me to have a consistent schedule with that. But I will be doing live streams on the road in the future. So yes, to answer your question, I will be doing more regular live streams. And in the summertime, we're going to be cranking out a lot more content. I'm actually hiring somebody, and they are going to be starting in late April or early May. So there's going to be a lot more website content, a lot more written content. And then I'm also going to be doing video counterparts to a lot of that written content. So this summer you can expect a lot more consistency with the uploads and the videos. And I'm also trying to move to a larger place. Right now, my place that I've been living in for 3 years is, I've kind of outgrown it and I don't have that much space. So every time I make a video, I have to put up my production set, so to speak, and then I have to take it down after I record a video, and there's just a lot of friction there. And so I'm hoping that when I move to a bigger place, I can have a more dedicated studio setup, at least during the week, and then I can just write out a video, sit down and record it, edit it, and then I can just crank out the videos. So you guys should expect more regular content in the coming months. Come to Longmont. Levi, do you ride park? Chris, which platform are you using? I am using Tastyworks. There is a link in the description where you can learn more about it. And yeah, if you want to support the channel and you decide to open an account with Tastyworks, using the project option code is a phenomenal way to support me and the channel. Does not cost you anything. But if you don't want to use the code, then that's fine. I understand that approach too. Dr. KC, all of your videos are very informative. Thank you for doing that. You are welcome. That's the goal. Real asks, what app is best to try your hands and options? You mentioned that you have multiple apps. I would recommend consolidating your money into one brokerage platform. I'm not sure why you would trade with multiple different platforms. I think that would make things very difficult for you, and you'll therefore have less money available because it'll be split up between 3 different platforms or however many platforms you're using. So I would recommend consolidating to one platform. Zaid, I'm not sure how to say your name. Thank you for the $5 super chat. Levi, thank you for the $1 super chat. I appreciate all your support. Mark asks, what's your P&L year to date for your portfolio? It's right up here at the top. So in this larger account, it is just under 50,000. In this smaller account, it is 7,000. Zach asks, how do you find your stocks for this strategy? I'm assuming you're asking about the strategy that I presented on earlier, and it's not something I would do in every single stock. If you'll notice, I did it mostly in these high growth stocks, which you're going to have to actually pay more for those options because the growth of those companies is expected to be very high relative to something like Visa. So on a more volatile stock, such as Tesla, the options cost a lot more money than they do in something that is a lot less risky, such as something like the mid-cap S&P 500 or the S&P mid-cap ETF. So if we look at the implied volatility here of IJH, which is a mid-cap ETF, then we can see that the implied volatility is around 25%. But if I go to Tesla, we can see that the implied volatility is like 85-90%. And that's because the volatility of Tesla stock, based on how uncertain the company's performance is and where people see the company in the future and the prospects of the company in the future, you have to pay a lot more for Tesla options compared to something like a mid-cap ETF like IJH. So to answer your question, I don't do the long call strategy in every single stock. You have to start with a very bullish assumption and outlook for whatever product or stock that you're trading, and then you start there. And I would recommend going long term, such as I have with these 2-year expiration cycles, so that you have a lot of time for your prediction to play out. When I buy options, it's typically a leap, which means it's a long-term option. And I very rarely buy options with 1 or 2 months to expiration because to me, there's just it can go wrong a lot faster than it can with leaps. So that's why I go long term. Gaurav asks, is tastyworks portfolio margin any good? Yeah, I would say it's good. So there are industry standards when it comes to margin accounts and portfolio margin accounts. It's not necessarily like a margin account with tastyworks is way better than a margin account with Robinhood because they have the same regulations. For example, if you don't have $25,000 in your margin account, then you are subject to the pattern day trader rules, which means you can only make a certain number of round trip trades, meaning that you can buy and sell something or enter and exit a position a certain number of times in a rolling 3 to 5 day period. I'm not sure what the specific rules are, but you have limitations if you have less than $25,000 in your margin account. And that applies to tastyworks, it applies to Robinhood, it applies to TD. That is not a brokerage specific rule. That is an industry regulation. And when you talk about buying stocks on margin, typically you can only get 2-to-1 margin, meaning that with tastyworks, if you have a margin account, you can buy $10,000 worth of stock if you have $5,000 in the account. And it's probably the same at Robinhood unless you have some sort of other privilege that you've applied for more leverage. But typically you can get 2-to-1 leverage in a margin account, meaning that you can buy shares worth twice your account value. So you can leverage your account 2-to-1. I believe portfolio margin is closer to 6-to-1. I'm not sure. I need to look into this more. I really should know more about it. But I know with portfolio margin, you need over $125,000, I believe. And then once you have portfolio margin, you can access more leverage, meaning that you have to put up a lower amount of margin requirement for an option position relative to somebody with a margin account. So I would say yes, portfolio margin with tastyworks is good. I think portfolio margin with any brokerage platform is good. But what I will say about portfolio margin is that since you get more leverage, meaning you don't have to put up as much collateral to enter option positions, then you can overextend yourself much easier than you could in a regular margin account. So you really need to be very careful with a portfolio margin account, and I would not recommend applying for portfolio margin if you're a newer trader. And first of all, you need over 6 figures to apply for portfolio margin, and then you have to take a short aptitude test where you answer questions about options and derivatives products so that they know that you have some knowledge about these products before they give you that increased leverage. But with more leverage means that, with more leverage, it means that it's easier to blow out your account. And so with portfolio margin, it will be easier to blow up than if you just had a regular margin account. So be sure that you know what you're doing before you open a portfolio margin account. Levi, thank you again for the $5 super chat. Do you go out and find new stocks each week, or do you trade options on regulars that you know well? Is there a strategy you use? Yes. So I basically trade all these options in my watch list. Is kind of my universe. I don't trade options on every single stock that I'm interested in. I can show you right here. So I can actually filter the stocks and the option position. So if I unclick options, only a few options are eliminated, which means that these are all stock positions. All of these equities I have stock in, which means I just own shares. And then these are the additional companies that I have option positions in. So I'm not always trading options. I have said this in the past, just because options are there, I don't think that you should always use them. I think options have a special place in a portfolio and in your overall strategy, but I don't think that once you learn options that you should forget about everything else and just trade options. I think it is a really good idea to continue with traditional investing approaches such as buy and hold. And if you don't have a hyper bullish outlook or a specific outlook on something, and you don't necessarily have the confidence in putting a lot of leverage at play like I did in MicroStrategy or Tesla, then buying shares is always a good approach. Don't forget about just buying actual shares of a company just because you know about options. I think that will get you into more trouble than it will do good for you. So do you have to be a U.S. citizen to open a tastyworks account? No. There is a website. If you search tastyworks international accounts, you can find a list of all the countries that tastyworks accepts applications from. So you do not need to live in the U.S. to open a tastyworks account. Yeah, and as CDH mentioned, if you're outside of the U.S., it will take longer to open an account with a U.S. brokerage firm, and it's not just with tastyworks. I think that's probably for most U.S. brokerage firms, is that the application process will take longer because it's just harder for them to look at your documents and whatnot. So it will take longer if you're not a U.S. citizen. It may take longer to fund your account as well. Green Ghost says, I like your outlook compared to only selling premium at Tasty Trade. Yeah, that's one thing about me is that I'm very open-minded. So my philosophy now could be very different than my philosophy in 5 years. But I think my philosophy has matured enough to where I don't see it changing significantly in the future, because in the past, it has changed very rapidly. So when I first started trading options, I was very much focused on shorting options and doing the whole premium selling approach. And then I kind of dabbled with lots of different strategies there. And I was overall just learning about how options worked. But then overall, my philosophy transitioned to a more broad philosophy, which is that I don't hate on buying options. I see it for what it is. And buying options works if you're right. I've made last year was the best trading year ever, and it was all because I was buying options and not just shorting options. But it was also a very special year because we saw massive movements in stock prices. And I also understand that my strategy that I've outlined here today, which is buying calls and then shorting another call at a higher strike, I know that that strategy is not going to be applicable to every single stock that I want to trade, and especially not every market environment that I want to trade in. So you always have to be open-minded, and that's my general approach, is just having an open mind. One thing I might not believe in now, I could believe in a couple years. And if somebody shows me that there's a good reason to change my mind, then I'll change my mind. So that's how I like to live my life. Thank you again for the $5 super chat. Chris, what do you recommend as a learning source for advanced option strategies besides your channel? It's a good question, partly because I don't think you need to make options trading more advanced. I personally trade very basic option strategies, and I think that's good news for you, because if you can master your understanding of basic option strategies, then that will set you up for a lot of success in terms of what you know. You don't necessarily need to make things more advanced. I would say the more advanced topics that you could learn would be understanding implied volatility at a very deep level, understanding each of the Greeks on an intuitive level, and then understanding how the Greeks change. That's probably the most advanced. Understanding how the Greeks change based on changes in the stock price or other factors such as time passing. That would be a good thing to learn. I think the best learning source is experience, for sure. There's only so much I can tell you, and even what I tell you, you may not understand it on a deep level until you experience it firsthand. So the best teacher overall is your own experience trading. Outside of my channel, though, I mean, you could read Option Pricing and Volatility by Sheldon Natenberg. That's kind of the options Bible, and it is very advanced, very math heavy. It's a very technical book, but if you want to get more advanced with it, then that's probably a book that I would look into. But overall, I think learning the basic option strategies, so buying calls and buying puts, and then shorting calls and shorting puts, those are the 4 building blocks of all option strategies. And then from there, I would master your understanding of the vertical spread strategies. So buying and selling call spreads, and then buying and selling put spreads. But again, if you understand buying calls, shorting calls, buying puts, and shorting puts, then that sets you up to learn vertical spreads very quickly. Chris, what do you think of Palantir for the next couple of months? PLTR. I think Palantir is one of those companies that I think we should keep an eye on over the next. I mean, they just IPO'd, so it's a very new stock. And IPO stocks, or new stocks that are freshly public, they're very volatile, as we can see. So Palantir was $10 a share, went all the way up to $45 a share, and now it's back down to $25. So there's a lot of volatility here. And if we look at the options will confirm that is a very volatile stock, because we can see that the implied volatility is 85 to 90%, which means that the market is expecting a lot of volatility from the stock in the future. But over the next few months, I'm not sure. A few months is not really that long of a time frame. That's why I like to, if I'm going to make a directional play, I like to do a long-term play. So go out as far in time as I can, which means January 2023. And understandably, I'll have to pay more money to trade these options. So for example, if I wanted to buy the 50 call in the 2-year expiration cycle, that'll cost me $720. If I buy that same option in the expiration that is the upcoming January, if I go to the 50 call there, I only have to pay $340. So it's twice as expensive to go out 2 years as it is to go 1 year out in time. But I prefer to go I prefer to go more than a year out in time if I'm going to make a big directional play like this. But as we can see here, this is a really good indicator. Open interest is in the thousands, tens of thousands in some cases at various strike prices. So Palantir options are very liquid, even in these longer dated expirations, which is a very good sign. So if you want to trade Palantir options, you have my stamp of approval. The name of the book, Option Pricing and Volatility, I believe. It's by Sheldon Natenberg. I believe that's how you spell the name. What are the requirements for applying for portfolio margin in tastyworks? I'm not sure exactly, but I believe you need $125,000, over more than that in your account. It might be more than that. I'm not sure. I have not applied for portfolio margin in the larger account that I'm trading, just because I don't necessarily need more leverage. But if you want it, then I think you need 6 figures for sure. And then you also have to take a test. So I think it's 10 to 20 questions, and they will test you on your knowledge of options. And they will ask you some very specific questions as well. So you definitely have to know your stuff. And I would not recommend cheating on the portfolio margin test by asking a friend who knows more than you, because then that's just a bad idea to give yourself more leverage when you don't understand the products that they're asking you about. So I don't think you need portfolio margin unless you really want more leverage, but you definitely need 6 figures. Gaurav says 175,000. Jimmy, thank you for the $10 super chat. I had to stop by since I've never had a chance to catch you live. Been learning about the market and options for almost a year. Your videos have helped me quit my job and trade full time. Thank you. You're welcome, Jimmy. Keep it up. Keep learning. Claim Your Free Stuff says, is it a good strategy to sell puts in stocks that you want to buy and collect premium along the way? And I'm going to kind of go on a rant here. Let's see. Let's look at Square. Claim Your Free Stuff is asking, is it a good idea to sell puts to purchase a stock that you like and earn premium at the same time? This is boring AF. All right, well then leave. I'm leaving soon anyway, so it's fine. They're asking, is it a good idea to short puts to buy stock that you want to buy? So here you go. If Square is at 237 and let's say you want to buy Square at $200 per share, you could short the 200 put. So if you short the 200 put for $11.50, then you can potentially make $1,150 on this put trade if Square is above the strike price when this option expires. Because if the stock price is above the strike price, the put strike price at expiration, then the put will have no intrinsic value. And if you sell it for $11.50 or $1,150, the most you can make is exactly what you collected for it, which is $1,150. So if you short the put for $1,150 and its price falls to zero, then you make $1,150. My problem with this strategy is that, let's say you really want to buy 100 shares of Square. First of all, if you buy 100 shares of Square at $237.50, and then it goes up to, let's just say, $260, then you will make just over $2,000, let's say $2,200 on your 100 share position. So if you buy 100 shares at $237.50, the stock price goes to $260, you'll make $22.50. Now, if you short this put option, you can only make $1,150. And so my problem with shorting puts as a way to buy stock is that if you're doing it in a stock that you are really bullish on long term, then I think it just makes more sense to buy shares because you have uncapped upside. So if you short a put, you have capped upside, meaning that you can only make what you sell the put for. So in this case, if you sell the 200 put for $11.50, the most you can make is $1,150. So that's all well and good, and you'll make that money as long as Square stays above $200 over the next 93 days. But another problem I have with the strategy is that people will say they are shorting puts to buy 100 shares of stock, but then once you short this put for $200 and Square goes to $175, now you have this big loss on the short put position, and now people are no longer comfortable buying shares at 200. And so if you're going to use the strategy, you have to really believe that that's what you want. So if you sell this put and then Square goes to 150, you can't complain about your short 200 put that is now underwater because that's what you want it to do. You want it to collect the premium to buy the shares at a lower price. But my biggest problem with it is not necessarily the downside. It's that you miss out on a lot of upside because if you short this 200 put for $1,150, that's the most you can make. And so let's say you short that put and then Square blows out earnings and the stock price goes up to $300 per share. Well, now you made your $11.50, but if you just bought 100 shares initially, then if the stock goes from $240 to $300, you would have made $6,000 as opposed to $1,000. And so I like to encourage people to avoid reducing their profitability by using an option strategy. And this gets back to what I mentioned before, was just because you know about options, it doesn't necessarily mean that you should use them. So if you're really bullish on Square and you are going to sell puts to buy stock because you're really bullish on Square, then I actually think it's a bad strategy, because if you're right about being very bullish on Square, then you're going to make way less money shorting puts as compared to just buying the shares and holding those shares long term. So that's my honest opinion about selling puts to buy stock. The only way it works out perfectly is if you are to, let's just make this really easy. Let's go to the 30-day expiration cycle. The only way this works out really nicely for you is, let's say you sell the 230 put for $12.50 and the stock price basically stays here or goes up a little bit, and then in 30 days you make the full $1,200 profit on this, and then you go ahead and sell another put and then you make another $1,200 and the stock price didn't really move. And that's when selling puts to collect the premium really shines, is when the stock price isn't increasing that much. So selling puts to buy the stock because you want the stock, it's a bullish strategy, but it's kind of, I don't really love it, because the only time it really works out in your favor is if the stock price is not really increasing that much. And that's the best case scenario. Then that means you're not really bullish on the stock. So selling puts to collect the premium and then wait to buy the shares at the strike price whenever you get assigned, that's more of a neutral to slightly bullish trading strategy. So I would not recommend really using this strategy. I personally wouldn't use the strategy if it was in a company that I really wanted to have ownership in. Because at the end of the day, when you buy shares of stock, you have uncapped upside. When you short a put, you have limited profitability. So you could miss out on those huge movements higher. And then if you're still with your put selling strategy, you have to sell a put at a much higher strike price, and you're going to make way less money overall compared to simply buying the shares. Arthur asked, I'm late for the video. Is a recording going to be on your YouTube channel? Yes. So after I finish this live stream soon here, YouTube will have to process the video, and then it will be uploaded to the channel so that you can rewatch the whole thing. And I will also put timestamps in the description so that you can skip to specific sections of the video, and then you won't have to watch the whole 2-hour thing and kind of figure out where we are. So there'll be timestamped sections so you can quickly find what you're looking for. Dean asks, yes, but what if you sell puts short term, like 3 to 5 days to expiration? Well, then you're not going to collect much money. So if I go to Square, I could sell the 235 put for $400. I mean, if you want to do that, then that's fine. I'm giving you my opinion. You don't have to agree with everything that I say. I'm just sharing things with you and trying to explain why I have that belief. Like a great example would be just the overall market. Like if you were bullish on the stock market and you were selling puts through this whole thing, you would have made money. But let's say you bought this S&P mid-cap ETF at $180 per share, and now it's at $260. If you bought 100 shares at $180 and now it's at $260, then you made $80 per share times 100 shares. You made $8,000. So the question is, do you think you would have made $8,000 or more selling puts through this entire thing? That's the question. And I know this is a big bull run, and I didn't start exactly from the bottom. I started after it had already rallied a little bit as my example. So if you bought at 180 when the bottom was 120, do you think you would have made $8,000 through this move? I mean, let's go take a look. If you sold the at the money 30-day put right now, you'd collect $6. So I don't know, maybe it would have been close. But what I'm saying is, if you're really bullish on the stock, I don't think selling puts is the best strategy, because you're putting yourself in a position that has limited profit potential when your outlook is really bullish. And I don't think if you're really bullish that you should give yourself a strategy that has limited profit potential. Dean, you can run the strategy. It's fine. I'm just telling you what I think and why I don't necessarily do that. Another benefit for me is that if I'm doing the short put every month strategy, then I have to kind of be watching that strategy. And for me, if I'm bullish on a stock, then buying shares or buying a long-term call, that's a much more hands-off strategy for me, and I don't have to trade as much. And limiting the amount of times I need to check my trading platform, it leads to a better life for me personally. But it might not be what's best for you. So I'm just telling you what I think. You don't have to agree with me. You can sell puts every month. That's fine. I'm just telling you, if you sell puts every month on a stock that you're bullish on, there could be a scenario where you are going to make less money with your short put strategy as you would in an uncapped upside strategy, such as a long call with a long-term expiration or simply buying shares of stock. JB says if it goes up, you win. Either way, you win. Yeah, you're right. So selling puts is a good strategy if the stock price goes down slightly or stays relatively neutral. But if the stock price goes up a lot, then selling puts makes way less money than owning shares of stock. There's always a trade-off in options. Between options and stock or different option strategies, there is always a trade-off. You give up one thing for a benefit in another area. So selling puts, you have a larger downside buffer. So for example, if you sell, let's just go to IJH. If I sell this 250 put for $5 or $6, then my break even is 250 minus $6. So IJH just has to stay above 244 and I make money. If I buy shares of stock at 263 and it goes down to 255, I lose money, but in this strategy I could still make money. But the thing is, again, what I said before, you make money with the short put if the stock price goes down a little bit, and you still have a better purchase price than the strike price when you short the put. But if the stock price goes up, which is a bullish outlook, if you think the stock price is going to go up and that's why you're shorting the put, then you're good. In a lot of cases, you'll make less money with the short put than you would with just stock. Yeah, I get the cost basis reduction approach as well. I get it. Haley says, I'd rather have smaller limited profits than unlimited low probability moonshots. I'm not saying, well, buying shares is not a low probability moonshot. But I understand what you're saying. You have a high probability of making money. But remember, probability of making money in options is always tied to the risk and reward ratio. So if you have a limited amount of profit potential and a lot of risk, which is technically what a short put is, then you have a high probability of making money. Conversely, if you short a call option, you have limited profit potential and you have unlimited risk, you have a high probability of making money, because in both of those trades, you can make money so long as the stock price doesn't move against you significantly. And that's why you have a high probability of making money. When you buy options, you have a little bit of risk and a lot of profit potential, and that's why you have a lower probability of making money. So you always have to think about what's the probability of making money, and that probability of making money will tell you the risk to reward of that position. JBATL says, you're not shorting the put because you think it will go up. You're lowering your cost basis. Stock is at 40 and my strike price is 35, so I'm buying the stock at a discount and lowering my cost basis. That's correct. You're right. But if you short the 35 put and the stock is at 40 and then the stock goes to 50, then if you short the 45 put, then now your cost basis is technically going to be higher because you have to short a higher put to still collect premium. So the game becomes you have to collect enough premium from selling all those put options and make enough money from selling all those put options that makes it worthwhile, as opposed to just buying 100 shares. So I understand at this point it's an argument that I'm not going to win. I understand how both strategies work. I was just pointing out the downside of selling a put versus buying shares. But like you said, there's a benefit to shorting puts as opposed to buying shares. There's trade-offs in both approaches. So it comes down to whatever you believe in. Great question. Thank you for the $5 super chat. Zaid, I don't know how to say it. I think it's Zaid or Zaid. Chris, in your experience, is there any proven strategy to overcome emotional stress during trading? Yes, there is a proven strategy to overcome emotional stress during trading, and that is to trade small enough where if you have a complete loss in that strategy, then you won't blow up your account. That will significantly reduce your emotional stress. Another way to really reduce emotional stress is to have a very defined plan. So before you enter a trade, you should know when you're going to exit that trade for a profit. You should know when you are going to exit that trade for a loss, if you are going to exit the trade for a loss. And if you are going to adjust the trade, you should also know exactly what will cause you to adjust the trade. If you have all these things laid out quantitatively, meaning that, let's say, if you get to a 50% profit, you're going to take the profit. Or if you get to a 50% loss, you're going to take the loss. Or if the stock price goes to X price, then you're going to adjust the strategy and you're going to adjust it in this manner. By having all those things laid out, then you will feel much less stress because you won't be in your head as much, because you'll have this plan in front of you that explains to you exactly what you're going to do in certain scenarios. And having that plan will eliminate pretty much all of your stress. So it's trade size and having a plan. Those are the two things that will significantly reduce your emotional stress when trading. So if you have a lot of emotional stress when trading, you're probably trading really big, and or you don't really have a plan. JBATL says if the stock is at 40, you short the 35 put, and then the stock goes to 50, then I collected a premium and do it again, you lose nothing. Technically, yes, you did not lose anything. You made money on your trade, but there is also opportunity cost. This is what I'm trying to explain. If you compare, let's say you sell a put at a 35 strike price. I'll just use a real stock so that we can see a real example here. In Apple, if I short the 120 put in expiring in 30 days, then I collect $350 on this. The stock is at 122.75. Let's just say Apple is at 120, just to make the numbers really easy. If the stock is at 120 and you sell the 120 put for $350 and the stock goes to 130, you're right. You made $350 on the put. However, if you would have bought 100 shares, you would have made $1,000. So technically, you didn't lose anything by shorting the put, but your opportunity cost, which is what you gave up by choosing the short put over buying shares, was $650. So you technically lost $650 because you made $350 by shorting the put, as opposed to making $1,000 from the shares. So let's say now Apple's at 130, and now you sell the 130 put, which it wouldn't be $900 because this is an in the money put. But let's say you sell another at the money put, and let's say this time you collect $500, and then the stock price goes up. Or let's just say you sell the 130 put for $500, and now the stock goes back to 125. So you essentially break even on this put, and then you take the stock at your strike price minus your premium of $5. So you buy the shares at a cost basis of 125. And then we subtract the $350 that you made from the first trade, which was $350. So 125 minus 350, that would give us a cost basis of 121.50. So based on that scenario, you did make money on that initial short put. He broke even on the second one. In this specific sequence of events, your cost basis would be 121.50, which is still higher than the initial share purchase price of 120 if we were comparing those two approaches. And I know in that case it worked out for buying shares, but the game becomes you have to make more money to reduce your cost basis enough below that initial share purchase price. And that's the whole game. But again, if for some reason you shorted the 120 put for $350 and the stock price went to 140, then you would have made $2,000 on the share position, but you only made $350 on your put. So technically, you didn't lose money, but you left a lot of money on the table by choosing the short put over buying the shares. But I understand at this point I'm not going to win this argument for you. And like I said, there's always trade-offs. With the short put, you have a little bit of downside buffer, and you have a higher probability of making money compared to just buying the 100 shares at the same time. But you leave a lot of upside on the table when you choose the short put over buying the shares of stock. And I know you said you wouldn't short the put if you think it's going to go up. You'd short the put because you think the stock is going to be neutral or whatever. But in my opinion, like if you think the stock price is going to go down, then you wouldn't short a put. And if you think the stock price is going to go up, especially a lot, then shorting a put, in my opinion, is still not as advantageous as buying the shares. It's just, it's all personal preference. I'm just trying to give you things to think about. Zaid, thank you for the clarification, and thank you for the super chat. Yeah, I'm done with the short put versus long stock thing. Um, but yeah, with everything in options trading, there's a trade off. So if we look at another example, if I buy this 125 call for $380, then I have unlimited profit potential, but it's a low probability strategy because I need the stock to go to 128.80. And if we compare that to selling or buying this call spread, if I buy the 125, 130 call spread, now I can only enter this trade and I only have to pay $170, but now my maximum profit is capped at 330. So the benefit of buying the call spread is that I have less risk and I pay less to enter the trade. But the downside of the call spread versus the long call is that now I have capped profit potential versus if I did not short this call and I just bought this naked call by itself, then I pay more and I have a lower probability of making money, but I have uncapped profit potential. So there's always a trade-off when you compare any two trading strategies, whether it's buying stock or shorting a put or buying a call or buying a call spread. There are always different trade-offs between those strategies, and you just have to choose for yourself, what do you think is the best thing for me to do or the best strategy to use based on what I think is going to happen in the stock. And if I'm right about what I think is going to happen in the stock, what is going to give me the best risk to reward? So how much risk do I want to take relative to what I think is going to happen in the stock, and what strategy can I put on that accurately matches what I want out of that position if I am right about the stock? And then also, am I comfortable putting on that risk if I am wrong about what I think is going to happen in the stock? So that's all you can do. All right. All right. I'm going to wrap this live stream up here. Thank you, everybody, for tuning in. For those of you who are just joining, be sure to watch the uploaded live stream in a little bit. First, YouTube will have to process the whole video, and that takes a little bit of time. So it should be up within the next hour. And like I said, I will timestamp different sections of this live stream so that you guys can skip through and go to the different sections very quickly. And so you can also catch the presentation that I did at the beginning of this live stream, which was my favorite option strategy, which essentially walks through how I was able to purchase these call options in various stocks and then create risk-free call spread positions or guaranteed profit scenarios in these call spread positions. And earlier in the presentation, I walked through very clearly how that math works out and why it has been such a great strategy and why I really like it. But as I also mentioned, it's not applicable to every single market. It's not applicable to every single stock. You have to have a very specific outlook, particularly a very bullish outlook for these different for this specific strategy that I mentioned earlier in this live stream. So thank you, everybody, for tuning in, and be sure to catch the re-upload of this live stream if you wanted to rewatch certain sections. I know we covered a lot today. And then finally, this is the tastyworks trading platform. I know people were asking who I'm trading with. This is tastyworks. If you're interested in checking out tastyworks as a brokerage platform, go ahead and check the link down in the description below. And if you like the work that I do and providing all these free videos for all of you, and you want to support my work, if you do decide to open an account with tastyworks, you can use the project option referral code, and that supports the channel and myself. And also, if you do that, there is a bonus kicker in there for you, which is that you get access to the exclusive course on the website that is not technically available for sale, but you have to, that's something that you do get access to forever if you do go through these hoops and you do support the channel by opening an account with tastyworks and using that code. So thank you, everybody, for tuning in, and I will see you next time.